طيب اسمحوا لنا الآن ننتقل للجلسة الرابعة والأخيرة. طبعا قبل الغداء، وبتمنى أنكم جميعا تكونوا موجودين معنا حتى ننهي على الوقت وكلنا نتوجه للغداء. إذن اسمحوا لنا أن نرحب برئيس الجلسة السيد فيصل حسن عثمان، المدير التنفيذي لشركة مجموعة العثمان الدولية الأردن، ليدير ويناقش هذه الجلسة الأخيرة. ستكون بعنوان اقتصاديات معيار IFRS 17 وأثار تطبيقه والتحول في التقارير المالية. Ladies and gentlemen, please allow us to extend a warm welcome to our keynote speaker for this session, Mr. Abdul Moid Ahmed Khan, Director of Actuarial and Insurance Advisory Services, based طبعا in Dubai, Riyadh and Karachi. We kindly invite him. Most welcome. You can start.
Okay, it's on. Mic is not on. Okay. Ladies and gentlemen, distinguished colleagues and guests, good afternoon. It's my pleasure to welcome you to today's session, The Economics of IFRS 17, Its Implications and Financial Reporting Transformation. Before we begin, I would like to take a moment to sincerely thank the Jordanian Insurance Federation for organizing this outstanding 10th edition of Aqaba Conference. The quality of organization, the richness of topics, and the depth of dialogue we've witnessed so far are true reflection of their commitment to advancing the regional insurance industry. Today's topic is not only technically important, it is economically transformative. IFRS 17 reshapes how insurance companies reflect financial performance, manage assumptions, and communicate with stakeholders. As the standard moves from theory into real-world application, understanding its broader implication becomes essential for actuaries, CFOs, and regulators alike. To guide us through this important conversation, we are honored to host one of the leading experts in this field, Mr. Abdul Ahmed Khan. He is the Director of Actuarial and Insurance Advisory Services at Shima Consulting. Mr. Abdul brings over 15 years of regional and international experience, having worked with insurance and regulators across the region. He has led numerous IFRS 17 implementations and contributed to global actuarial working groups, including these under IOFI, ICAP, and the Saudi Insurance Authority. His insights will help us better understand not only the technical framework of IFRS 17, but the economic behavior it drives, from pricing and reserving to investor perception and long-term capital planning. Please join me in welcoming our distinguished speaker, Mr. Abdul Ahmed Khan.
Thank you, Faisal. Thank you. I would like to stand and thank you, Faisal, for the introduction. Masaul Khair. So our today's topic is the economics of IFRS 17, its implication and financial reporting transformation. Sorry. All right. Today's agenda, we will discuss the IFRS 17, some recaps that how IFRS 17 has impacted on insurance company financial standards, their financial statement. We will also discuss the very high level transition impact on Jordanian insurance companies. We will also, going forward, discuss the general, the governance matters, that how governance impact on the overall reporting process. We have very small 2 case studies to discuss for general insurance and life insurance company, how what has been done and what needs to be done, let's say. Then we have like one small presentation on new KPIs, key performance indicator, and eventually the transformation area. I would like to mention that all the opinions and the presentation are based on my own experience, and basically I will just sharing my Middle East, you can say, experience on the today's IFRS 17 topic. As a big picture, IFRS 17 is basically requires 3 types of accounting. For those especially who have accounting background with IFRS 17, they may be aware that these 3 accounting requirements are now new under IFRS 17, which was not as such required under IFRS 4. So previously in IFRS 4, we used to have simple approach, which what we call as premium allocation approach, which is more or less similar. However, there are some new requirements which we will discuss during today's presentation. So basically all the short-term business, generally most of the short-term business, motor, medical, accident liability engineering, and so on, and including reinsurance short-term treaties, they fall in premium allocation approach, which is, from the technical perspective, there are some new requirements which we will discuss again. What are those new requirements for the general insurance company? Then we have the 2 new accounting requirement, which is called measurement model, general measurement model, and variable fee approach. So these 2 are completely new, especially applicable for the long-term contracts. And we have seen generally that the term life insurance, endowment, universal life, they are falling in the general measurement model, and there is another requirement for variable fee approach. So that variable fee approach, again, there are some accounting standard requirement that needs to be satisfied in order to adopt variable fee approach. So there are some unit-linked product which sort of fall there. Some long-term reinsurance treaty also fall in general measurement approach, which is also a new requirement for the insurance company. There's another new area which up till now, as we know that in Jordan IFRS 17 has been implemented, and in most of the countries. So this is one of the area which impact on the insurance companies. The way they were presenting earlier, it was actually line of business level. Now this line of business level has been changed into the level of aggregation, and that's what we call in terms of 3 layers. So first is like, instead of like line of business, you have motor, then we have portfolios, medical, then you have portfolios where we have like group SME or maybe individual portfolio. So these are now further classified into segregated level. And then we have, maybe within group business, you have underwriting years. So that underwriting year, like say 2023, 2022, 2021, etc. So that is a second layer for the accounting purpose. And the third one is profitability tagging. So this profitability tagging and the accounting underwriting year cohort requirement was not there in IFRS 4, the previous accounting standard. This is completely a new requirement. Now, insurance companies have been working in terms of identifying the profitability tag, whether it's an owner's portfolio, it's profitable portfolio, or it's maybe others unknown. And that assessment insurance company has been doing at inception. This is again the requirement. So one of the significant change that again we will discuss in next slide, that these 3 layers requires the calculation to be done in differently as compared to what we have been doing in IFRS 4. Similarly, to at the end of the day, you have these group of contract which we call GOC group of contracts, which is like your let's say medical, SME, 2023, owners and non-owners, and etc. etc. Okay, so as we know that IFRS 17 has been implemented in almost like many countries, in Arab countries as well as in Middle East. So I'm just trying to give a recap, and then I will focus on the governance, that what need to be done as a next step in order to ensure that the financial reporting process is more smooth, accurate, etc. So in terms of the impact on general insurance, the first of the requirement we have seen is the premium allocation approach, the eligibility criteria. So that sort of require, as we mentioned, there are 3 accounting standard requirements. So in order to follow the premium allocation approach, we have to prove based on eligibility criteria. If it is, let's say, short-term 1-year contract, you can simply follow. But some of the treaties are not short-term 1-year contracts. So, and maybe some contracts, let's say engineering contracts, they are more than 1 year. So those contracts require the eligibility proof that they are still eligible in order to follow premium allocation approach. Second is the requirement related to value of insurance liability, which is sort of require explicit risk adjustment calculation and incurred liability. Now, when I say moderate to high, so most of the companies, they don't do an IFRS 4 explicit buffer, explicit risk adjustment. Now it is required in IFRS 17 to identify how much is your best estimate, how much is your additional margin. With that additional margin, they have to do some actuarial techniques, which is maybe some value at risk method, cost of capital method, based on your actuarial assessment. And then they will have to calculate the additional component of the risk adjustment, which is the extra amount which the insurance company is keeping as a buffer, which is transparent now. So in IFRS 4, when you look at IFRS 4 financial, you cannot say, anyone, the reader of the financial statement cannot say that how much additional risk margin does the company have. But now in IFRS 17, this is explicit. No day one profit, I think this is more or less similar in what we do in IFRS 4. We have like UPR concept. We don't recognize immediate profit. So this is more or less similar. Next is basically we have presentation. So now presentation wise, the P&L balance sheet look very different. Previously, basically the way insurance service revenue, insurance service expense, it was like used to be premium minus GWP and so on. So now this has significantly changed in terms of the presentation side. So apparently it looked like that obviously this, on the back end, there is a calculation, or maybe IFRS 17 engine has been used, but the calculation have, presentation have changed. As I mentioned, the impact of level of aggregation, moving from line of business to group of contract, this is one of the area which is very important for insurance company, because previously they determined premium deficiency reserve PDR in IFRS 4 at the end of the period. Now, with following this requirement of level of aggregation, they have to do assessment at that contract inception to determine whether is there a onerous portfolio or profitable portfolio or others, and based on that they need to set aside onerous liability as well. So this is a new requirement, that's why we mention as high. In IFRS 4 we generally don't do discounting of liabilities, etc. This is very significant area where insurance company are now discounting their liabilities, and based on that discounting they have their liabilities obviously have decreased because due to the use of the discount rate, and the unwinding impact of discount rate is a new item for them, that whenever they initially decrease the liability, the next year in the roll forward calculation, there is an unwinding impact. So when we are saying that new risk adjustment, onerous contract, discounting impact, presentation has changed, so there are new disclosures as well. Those disclosures were not there in IFRS 4. Now they are required in disclosure 100 and disclosure 101 as per the standard, and these are mandatory to be reported separately for gross insurance and separately for reinsurance contract. There are lots of judgment. That's where the governance, we will talk about the governance, that lots of judgment to be made in terms of accounting policy choices, which yield curve you will use, maybe very high yield curve, very low yield curve, whether the change in yield curve, because when you use some yield curve and if you change the yield curve going forward, not from the approach perspective, whatever the basis you have adopted, and consequently the yield curve change, then there is an impact again. Though that impact maybe should be flow through profit loss account or other comprehensive income. That's again a new item for general insurance that have been observed. Reinsurance, typically previously in IFRS 4 companies do reinsurance calculation based on simple mapping of gross to RA. Now it is required to separately calculate reinsurance liabilities. Data management and IT infrastructure, I think this is one of the very important area which companies some companies, maybe even big companies, small companies, they somehow manage to do as per our own experience in the Middle East market. So some companies follow proper IFRS 17 engine, some companies just adopted Excel-based tool, which sort of create this data question on their IT infrastructure, their financial reporting process, their data, and so on, so many challenges. Taxation, yes, we have seen when it's obvious when you adopt a new accounting standard with new methodology, then your profit or loss will change. Therefore, there is an impact on taxation. The methodology based on which tax is calculated, that is also changed. There is another impact on the stakeholders, which are actuarial, financial, finance of team, IT, compliance, audit. So these are all the impacted functions which requires to understand completely IFRS 17 such that this can be a smooth process going forward. And last, for the general insurance, is chart of account. If they don't, let's say, follow sophisticated model in terms of financial reporting, they don't revise the chart of account, then the financial reporting process will have not be very smooth. So I think especially for the finance team, the way they have been doing accounting in IFRS 4 is very straightforward. From the core system, they get the trial balance. That trial balance they use, and for the financial reporting, there are templates ready to prepare P&L balance sheet. That we still require under IFRS 17, such that the process should be very smooth and to be used properly. So these are the overall general insurance impact. Now we will move to the life insurance side. So as I mentioned, the life insurance with general measurement model or variable fee approach have a more impact as compared to the general insurance under PA. There are significant new terminologies that we have noticed. If you see, for example, the financial statement for life insurance company, there are literally new items that have never been understood or noticed. And some of the items, let's say the word new fulfillment cash flows, contractual service margin, these items were never used in the previous financial statement. Now, the financial statement, if the reader of the financial statement does not know, especially the doer who is like maybe actuarial finance on the IT side, if they don't understand properly, there's a consequence on the financial statement. So first is the fulfillment cash flow, which is more or less it's like actuarial calculation. So for life insurance, the important point to understand that the financials are also driven by the actuarial cash flows. So those actuarial cash flows are used in your projecting your profit loss account and balance sheet. So that's what we call fulfillment cash flow, which are similar to mathematical reserve. However, they have so many new requirements. In IFRS 4, we used to recognize upfront profit, which is very common. Let's say for single premium, you receive single premium, you have a small, let's say, change in cash value reserve, and then you recognize immediate profit. And then single premium, for example, policy maybe have a 10-year remaining term, but the upfront profit have been recognized. So these type of things are not allowed under IFRS 17 due to the creation of contractual service margin liability and so on. So that's a completely new impact that has been noticed. Now, when you create the CSM, then the release of the CSM, because what is CSM? CSM is like unearned profit, which you need to recognize at inception. So that unearned profit will be released over the period of the term based on what we call coverage unit. So those coverage unit are actually used to release the profit, and especially for the GMM and VFA methodology. So now what should be the mechanism for the coverage unit, how they should determine whether they are linear, non-linear, or maybe some based on some service provide pattern. So this is again a requirement from the actuarial and accounting perspective to determine the pattern for the unearned profit release. So in simple word, for general insurance company, they have kept UPR. That UPR is released linearly 1/365. But for life insurance company, they have CSM, which is maybe for 10 years or 20 years. They cannot linearly release that CSM. So that's where the impact is. Presentation significantly change. Especially, for example, when we talk about, let's say, the actual expected analysis, so that significantly impacted on the company's profit loss account. So companies will have to do actual and expected analysis in order to determine the revenue account. So the revenue account is completely linked on the actuarial side as well as the actual side. Again, there is a requirement for level of aggregation, which we have already discussed. There's one important topic which we have noticed is like deposit component, which cash value. So that cash value effectively is not used in profit loss account. So when you receive premium, this is not your actually, which include your some of the part of the universal life, let's say cash value, unit linked cash value, which you eventually pay back to policy holder. That cash value is actually not your revenue. So that IFRS 17 said when you recognize GWP, gross written premium, that's gross written premium should not under IFRS 17 have this cash value component. So that's where the one of the change comes in. When we talk about this complete new change, there are some of the items which fundamentally change the accounting reporting process. So for example, we have data, how we process the data, what type of data you maintain, what type of data you store. We have some cash flows determination, whether the cash flows you determine are have actually certified. Some yield curve process, so whether the yield curve you are using is, again, how you determine the yield curve and impact on yield curve. There is a new requirement for the systems, especially for GMA VFA, that those systems need to be used properly, should be validated, etc. And then basically one of the significant areas is trial balance, where the trial balance posting logic, which is completely new under GMM and VFA, that also need to be modified. The remaining two items are chart of account and experience adjustment. So again, I don't want to go very technical on this topic, but there are some significant many items which is not common in our existing language. On this impact loss slide, basically, we have some new disclosures. I think we discussed. Similarly, we have loss of judgment to be made. Similarly, the reinsurance accounting needs to be completely independent as compared to the gross cash flow. We have to have data structure, taxation impact, and actuarial and finance and IT compliance impact. So I'm not repeating those impacts which are there in general insurance as well as for life insurer, but certainly these have been impacted significantly. Now, standing in Aqaba, I thought to present just from the financial statement publicly available, I just thought to present some impact on equity which has been reported by Jordanian insurance company. So what is impact of equity? Again, when you adopt a new accounting standard first time, so you will have to reassess your liabilities under IFRS 17, and then the difference will flow through retained earnings. So your IFRS 4 liability, IFRS 17 liability, based on new accounting standard, whatever methodology you are following. So we have noticed that most of the companies have negative impact, which means that their liability increase under IFRS 17 and equity reduced. So this is other than one company, which is a life company. So what factors have been caused in terms of having a impact positive or negative? So this is what we are trying to explain. Like acquisition cost, for example, if you defer currently, for acquisition cost, for example, if you expense immediately and now you're deferring, so this means that you are creating an asset, and that asset is sort of having positive impact on equity. The vice versa is basically if you are not deferring, that's a different thing. Insurance contract, maybe for example for life insurance, they are already discounted, but those discounted may be higher or lower. So from IFRS 17 discounted, so again the impact will go accordingly to positive or negative. Risk margin, again as we mentioned in IFRS 4, risk margins were built in, not transparent, so we don't know whether those risk margins were, let's say, adequate or not. So if you have a higher risk margin, then obviously your equity decrease, otherwise it will increase. Immediate recognition of losses, this will create new liability, so your equity will decrease. Deferment of issuance fee, for example, if you don't defer issuance fee, now you're deferring, so these type of things will create an additional liability and equity will be reduced. So these are couple of items and factors what we generally have noticed in all the Middle East market that have impacting equity. Now we are moving to a case study. Again, based on my experience, this has happened literally that upon actually they determine the actuarial liabilities. They sign off the liabilities, but they think that whether the outcome in the financial statement is exactly same or not. So they didn't sort of verify whether the same liabilities have been used, and eventually the financial statement produced have different liabilities. And we also noticed why it happened that sometime insurance company have some data adjustment, and those adjustments were not automated, and therefore they have to do some manual adjustment, and the liabilities have changed. We have also noticed that insurance companies in Middle East market side that have adopted IFRS 17 engine, but it's not very well tested, validated. Eventually, if it's a logic, if garbage in, garbage out. So for example, if you don't test some new software or new logics, then obviously it will have an impact. So this case study, basically what we need to do, and this is our today's topic. After that, the lack of governance, I think, is a problem. The lack of governance in the financial reporting result basically produce delay in submission, credibility of the submissions, as well as maybe you have like auditors maybe challenging you, for example, that why this has happened, what has gone wrong. Auditors are using their own softwares and testing them. So, but eventually this comes as an insurance company that why the governance is matter. Similarly, sometimes insurance company rely on third-party consultant who may not have a local experience. For example, when we are working in UAE, so there are obviously international players, let's say those players, they don't have, let's say, local experience in UAE market, for example. And those companies are just using their IFRS 17 judgment, but they don't know how the local experience needs to be customized in their engine. And eventually, that sort of caused an issue in the overall reporting process. Life insurance case study is more interesting, especially when one of my client, I cannot quote the name of our client, and when we were discussing, it's a very big life company. So when we were discussing that, look, this is your financial impact transition, and they have a very big portfolio life insurance. So they said, okay, you have like maybe multiple assumptions. That's where the impact on equity comes. Maybe if you change the assumption, the equity will also be changed because this is transition. So why different approaches produce different results? I think this is one of the key questions from the board, and board is certainly concerned about the equity, the capital, and so this is one of the, again, area where governance is important. Actuaries and CFOs, chief financial officer, they are driving the profit loss account, especially for the life insurance. So this is where the governance also again comes in. So how we have to resolve, so use of assumptions, methodology, accounting policy choice. These are three key areas. Accounting policy choice, what have you adopted, whether those accounting policy choice matches with your P&L balance sheet, etc. Similarly, one thing we have also noticed in this case study that some companies on life insurance, they have reported positive impact on equity, and they are also having positive profits as compared to IFRS 4, because most of the companies in Middle East market, they are still reporting IFRS 4 and IFRS 17 together. So they compare their 4 and 17 profits. So those 17 profits sometimes are higher, having positive impact on equity. So whether, and one thing is very clear, this accounting standard is not giving you more profits. Accounting standard is just a new standard, but it's not changing the profit or loss at over the life of the policy. So that is again a key area where governance also matter. So now, in which areas I think governance is very important. So one of the areas, total profit or loss is still the same. So we need to make sure, for example, you should not let's say having a positive impact on equity, and then you distribute a lot of heavy profits or dividends, for example. Or maybe because it's a timing difference effectively. Or maybe on takaful policyholder, you have a surplus, and that surplus you distribute based on because there's a positive impact, let's say. So that should not be done. Again, you basically need to have a governance policy that what is required, what is done, why, what needs to be done, because the profit or loss will remain the same over the life of policy. We have seen discounting. So the way this yield curve is derived, that is also one of the important area. Governance is matter. Loss component. One of the key challenge we have noticed in Saudi Arab, where regulator also intervene in Saudi Arab, that how to set the group of contract definition. That, for example, you have maybe motor, medical. Within medical, you have. By the way, in motor in Saudi Arab, there are aggregator, non-aggregator, and then there is so many like channel of the business, which some business are very profitable and some by default are loss making, or maybe competitive. That's why loss making. So therefore, at which level the group of contract needs to be calculated. This is something where because it is actually not subsidizing between profit and losses. So in IFRS 4, you have total motor, let's say. Total motor may have multiple lines, multiple channels, where some of them are loss-making, some are profitable, and it's mixed. But in IFRS 17, it's subsidized, not subsidized, it's segregated. I think one of the important areas, stakeholder, is steering committee. Generally, insurance authority, for example, in Saudi Arab, so they very clearly specify that I think there was a quarterly requirement that the steering committee need to report, but it's not anymore required, but in the past, that the steering committee need to quarterly update, let's say, regulator based on what progress has been done, and with the sign-off, by the way. Those sign-off means that the actuarial IT and internal audit, so basically they wanted everyone to go together. So because again, in some countries we have noticed that IFRS 17 has been implemented, but the internal audit is not, let's say, up to date. They think they will come back and then they will see once it is fully implemented. Again, this key stakeholder sign-off is a must, that all parties are involved and they understand what they are doing. As I mentioned, I think the model testing validation is one of the important area. I think I already mentioned. Data, I think significant challenges on data side. I will give you one example. Let's say when you have some sort of reinsurance accounting and reinsurance data, most of the companies they have like significant challenges in keeping proper data. Receivable, payable, at what unit of account, they have maybe total reinsurance level or maybe total line of business level. So that is one of the key challenge in IFRS 17. So again, data, sometimes insurance companies are relying on third party, let's say TPAs, medical TPA on the data, which data, what they are processing, they are used in financial reporting. However, it also has an impact in. One of the important areas is the conflict of interest. The reviewer and doer should be independent. That's one of the governance area. Risk adjustment, choosing high, confident interval, low, whether your board is aware. Some companies we have noticed as our client that they want to keep very high risk adjustment. And those our client, we suggested that we need a board, let's say, approval, such that the board is aware that you're keeping high buffers, for example. So these type of things are important in terms of governance. Tax authority, again, because of the change, that's again very important in terms of the taxation. There's a requirement in UAE in terms of the internal control over financial reporting. This sort of requires the assessment and effectiveness, how the financial statement have been produced, and this need to be signed off by the external auditor. Thus, in UAE. So this, by the way, this was the first year it was required there, and companies are sort of asking their auditors to certify their financial reporting process. Eventually, knowledge transfer. Takaful, if I start Takaful, I think I can take half an hour to speak on Takaful. So there are some Takaful accounting issues. I'm part of the AUFI where I have like written and contributed significantly in writing the FAS 42 and 43 accounting standard in AOFE. FAS 42 is like IFRS 17 accounting standard, so for the couple companies. So where we have noticed significant challenges. I think second last, or maybe third last slide. So we have new KPIs because financial statement have changed. So effectively your there should be new KPIs how board, CFO, CEO will evaluate. So some of them are mentioned here, but obviously there is a long list. So risk adjustment, you can just see maybe risk adjustment divided by your total liability for LIC, liability for incurred claims. So maybe one threshold. So you can see whether risk adjustment is 5%, 10%, 20%, 50%. Similarly on the reinsurance side for the risk adjustment. Then we have like expenses, like some of the under IFRS 17, it's a requirement to reclassify expenses. So based on that, you will see whether it's attributable, unattributable expenses. And those expenses effectively, how much proportion you have in terms of the KPI. CSM, unearned profit for life company, very simple language, unearned profit for life company, CSM. That unearned profit for life company, how much is created for, let's say, new business. And I will give you a very short example. So one of our client was merging basically their portfolio with the another company, and they have reported the CSM in the balance sheet. So that CSM basically was very transparent and obvious that and easy for the due diligence purpose, assuming the assumption everything is same. So they sort of use that as a company, you can say profit, like expected profit that will be reported in future. So that is like more transparency in terms of the financial statement. We have now this accounting standard also tell you if you see any profit loss account, you can immediately tell whether your reinsurance contract are profitable loss making because there's a net gain or cost from reinsurance contract, so that anyone can easily evaluate the reinsurance contract assessment. What we need to do to transform our financial reporting process. I think I already talked too much about governance, but this is one of the significant area. Some of our clients, basically in a very large company, so they have like very sophisticated reporting system. In that reporting system, they use the new trial balance and to prepare the profit loss account balance sheet. So there is no manual sort of link at all. So they just get the numbers from financial reporting standard, put it there, and the financials have been produced. So that's the ultimate stage, ideally. One of the area is basically manual work. Again, once you have the automation, you reduce your manual work. Data, again, try to manage the data properly. That's if you have the data challenges, I think this is you are far away from the automation then. IFRS 17 engine ideally should not be Excel, should not be at all. If you are working in Excel, you can never automate because the world is moving fast. They are moving toward Python, and they have so many software languages. If you are still using Excel, this means you are going back effectively, even from IFRS 4, because IFRS 4 still give you core account trial balance from your core accounting system, and now you are going back in terms of Excel. There has to be like IT control in place. I think one of the important point in terms of key personnel is IFRS 17 knowledge. Especially this will be a roadmap for Jordanian professional working towards maybe actuarial side or CFA side, accounting side. This is one of the very important area where they can utilize and start planning now, have some credentials on any accounting side, not just necessary actuarial, anywhere. So this will also help in terms of the professional to grow up under IFRS 17. I will also give you one. So some of our clients, especially life insurance, they have decided to hire actuary in their finance department. So because they understand that for life insurance, especially that the actuarial role is more important, so they have sort of decided there, and they are working more smoothly now. Audit and compliance. The compliance need to make sure internal audit, external audit, they also have to make sure their own job. The internal audit, for example, from process perspective, external auditor need to review independently all the things. So effectively, this is something eventually help in terms of transformation area. So that we are happy to take questions. I hope the presentation was useful to understand the post IFRS 17 challenges and what ideally need to be done after the implementation of IFRS 17. We are happy to take questions. So, thank you.
Thank you, Mr. Abdul for this insightful and highly relevant presentation. It's evident from your presentation that the IFRS 17 is not only transforms the financial reporting landscape, but it also challenges us to elevate governance, data security, and actuarial accountability across the board. We now open the floor for any questions. Yes.
Thank you so much for this informative session. Rich information is provided. My name is Riyadh. I am the CEO of Go Global. I would like just to highlight the things that you have shown regarding the governance part, as well as grouping. Additional thing is the profitability. Do you think regarding these three major topics that should be highlighted in managing the IFRS 17 in any insurance company, that there should be some highlights from the regulator in order to manage such things? For example, for the governance part, we need, let's say, who are the parties that are engaged into the reporting process, as well as the way it is reported and the type. I think the Central Bank of Jordan has issued robust directives in this regard regarding the D100 report, D101 as well. The second thing is your opinion in grouping. I think that it should be bottom up, from contract level up to portfolio level. Now, whatever the practice is, but we recommend to have it from the bottom level, contract level, up to the portfolio level. The third thing is that there should be let's say a calculation for the profitability, to do judgment on the profitability of contracts. There should be interference for the regulator in this in order to include some parts of expenses, let's say, or the loss ratios, etc., and on contract level, rather than the current practice that is working on a portfolio level. Your opinion is much appreciated in advance. Thank you so much.
You want to say?
No, go ahead.
Okay, thank you. Thank you for your all three questions. First, I would like to mention that I can provide my own comment, not as a behalf on the regulator. So, your first question, I think, in terms of the governance, especially the purpose of steering committee has been set up, as I mentioned, in other countries, and those steering committees effectively used, let's say, for disclosure 100, 101. So, what items have been checked by, let's say, the internal actuary, because like say in Saudi Arabia, for example, there's a concept of head of internal actuary. So that head of internal actuary is also has to sign off on multiple items. Similarly, and the appointed actuary is involved, CFOs are involved. So those disclosure 100, 101 in terms of process, in terms of the financial statement. There's another certificate, by the way, in Saudi Arabia, which requires every quarter appointed actuary, CFO, with sort of colorful items that how they sign off on disclosures, let's say. So there are so many things multiple regulators have adopted, but the again core will come back to the governance process. The governance will always be within the company, and that within the company means that company generally, for example, use appointed actuaries, CFOs, and their internal audit team to effectively work accordingly. So I hope that I answer your first question, right? Second, in terms of the basic profitability, right? I will just answer the profitability thing.
It's like the grouping, how does it go?
Yes, so again, basically, for life insurance, it's very easy. Some of the life insurance company, they start the grouping, as you mentioned, let's say from policy level. So they start evaluating the cash flow from policy level, and then basically those policies have been independently assessed, each individual policy based on some expense factor assumption, let's say, or whether they are profitable or loss making. But same logic, if you try to follow for general insurance company, that's more difficult. Why? Because when, let's say, we talk about medical group policies, let's say, and where you have the medical group underwriting, and those group underwriting, some of the cases by default they will be loss making because everyone may not make claim. Everyone will have some of them are claim will make claim, and some of them will not make a claim. So, and you don't know, maybe there is a policy for last 3 years which did not make a claim at all, but maybe 4th year they will make a claim, and some of them again have been loss making and they become profitable. Now the question is, this assessment at policy level is very tricky, and it's not ideal, in fact, to follow. Therefore, the standard requires, if you strictly follow the standard, it requires to assess at the group of contract level. Now, group of contract could be defined at various sort of levels. Maybe some countries they define as let's say with aggregator channel. For example, they are selling their SME policies through aggregator, which are like online channel where insurance any client can go to the website, select rates, and
you need to expedite a little bit because the time is running out on us.
Yeah. So I think so I think this is something which is like a group of contact sort of defined.
Okay. So I believe what we can summarize is basically the IFRS 17 is just not a standard for financial reporting. One of the most important matters is that it affected the companies itself, the underwriting process, not just the financial department. Do you agree on that?
Yeah.
So it affected multiple levels of the company, that this something has to be highlighted by for everyone.
Correct.
I hope that answers most of your questions, and we thank you very much for.
Thank you.
Yes.
Thank you for this fruitful session. Thank you. And now I would like to invite His Excellency Dr. Moid Al-Kloub to honor Mr. Abdul Moid Ahmed Khan and Mr. Faisal Hassan Othman. هذا إثبات على الهواء مباشرة دكتور. إذن الحضور الكريم، وفي ختام أعمال المؤتمر، جلسات المؤتمر الدولي العاشر للتأمين، مؤتمر العقبة 2025، والذي عقد تحت شعار مد الجسور بين مستقبل التأمين والتكنولوجيا، نتقدم بالشكر باسم الاتحاد الأردني لشركات التأمين والاتحاد العام العربي للتأمين لكم لحضوركم ومشاركتكم في جلسات المؤتمر، ونخص بالذكر السادة الأشقاء من الدول العربية، كما نأمل أن تكونوا قد وجدتم فيه جميعا فائدة وإلهاما تعينكم في مسيرتكم المهنية. نتمنى لكم دوام التوفيق، وإلى لقاء قريب في فعاليات قادمة.